What's up, guys? Welcome back to Everyday Money. As you guys probably have noticed, the markets are down throughout pretty much any of the financial sectors. For example, stocks are down. The NASDAQ is off almost 6% year to date. The Dow is down about 1.6 year to date. And the S&P 500 is down almost 3%. Also, if you're following any of the cryptocurrencies, pretty much all of the cryptocurrencies are down. But just looking at the big ones, Bitcoin right now is down about 13%. Ethereum is down almost 20%. And any of the meme coins that we're into, such as Shiba Inu token, Doge Elon Mars, Dogecoin, those are all down. Everything is down, and there's pretty much one reason for all of this to be happening so quickly in the beginning of 2022. Well, almost one reason. Obviously, the Omicron variant of the COVID-19 virus has just been going absolutely insane. Cases are through the roof, higher than they've ever been. But in my opinion, all those things are with the COVID virus have been fairly factored into any of the financial markets, and it's going to take a massive shutdown on a worldwide level, I think, right now to shock the markets with the virus. The thing that's going on right now is that the Federal Reserve has decided that they are going to pull us back off of this stimulus drug, take their foot off of the accelerator, and try to get the nationwide monetary policy back towards something of a normal state. And that is putting downward pressure on all of the financial markets, the stocks and cryptocurrency, because those two are not so unrelated as maybe they used to be, or maybe people just thought that they were. And the reason for this is twofold. The Federal Reserve has to get this inflation that we have going on under control, because it is we're seeing inflation rates that we haven't seen in 40 years, and if we don't do something, it's going to end up becoming a very big problem in the news for inflation and for just the everyday person on the street. The other is that the Federal Reserve needs to reload their magazines for when the next major economic crisis comes along, so that they have the tools that they are able to deal with that without having to take extraordinary measures bigger than they have had to do for this and for the housing crisis that they were actually still trying to get out of. So the deal is that when the economy gets in a rut, and you can look at this kind of like your roads, when you have a normal economy, you're speeding down the interstate doing the speed limit or probably a little bit more, like most people do, and then you get off of that interstate at some point and you're on one of these side roads. That's what happens when the economy slows down. So what the Federal Reserve does is they say, all right, we need to stimulate the economy. We want to get back on that interstate, so we got to hit the on-ramp. And what they do is, just like you smash down the accelerator on your car, they smash down the accelerator on stimulus. And what that typically means is they're going to lower interest rates, and they are going to buy bonds and securities, such as mortgage-backed securities, to pump money into the economy and to reduce the cost of borrowing, to allow companies and individuals to spend and borrow more. And so that foot on the accelerator is like getting on the interstate. And so you're cruising up that ramp, you hit the 70, 75, 80 miles an hour, depending on where it's at. But when you get to the point where things are sort of back to normal as far as the economy goes, or things are going well, if you continue to hammer down on that accelerator, now you're starting to go 90, 100, 110, 120, and you are in for big problems. You're either going to end up getting in a wreck, or you are going to get stopped by the police, and you're in general just gonna have a bad day. So the Federal Reserve has had their foot on the accelerator now essentially since 2008, 2009, with a brief period of trying to get back to normal between 17 and 19. So now we are at this point where, according to the figures, according to the things that the government looks at, we are at about full employment, and inflation is starting to get horribly out of control. This is where we are going over the speed limit. So what the Fed has done, and we have just seen the meeting minutes from December, from the FOMC, the Federal Open Markets Committee minutes, and what they are talking about is a much quicker return to normalization than they tried to do between 17 and 19 from the fallout from the housing crisis from 2008 to, so let's say, 2011 or 12 or so. And what they have said is right now the rates are about 0 to 0.25 on the federal funds rate, which is essentially a 0% interest rate for all things to be considered. They are talking about raising interest rates 0.75% in 2022, maybe starting as early as March, but then also having 3 rate hikes as well in 2023 and 2 rate hikes in 2024. And like I said, additionally, they're going to be starting to taper down their bond buying program. And it's pretty easy to see how interest rates can affect monetary policy, because when the Fed sets their interest rates, what that does is that indirectly affects how people buy items on credit, how businesses operate on credit, because the federal overnight funds rate, that is what banks use to lend money to each other in order to cover their minimum deposits required for the amount of lending that they have. And so anytime that this rate goes up, it inevitably creeps up the rates of mortgages, the rates of car loans, the rates of credit card rates, and the rates that businesses pay for their lines of credit. And a lot of businesses operate on a regular basis on lines of credit where they purchase raw materials or they make payroll with that line of credit, and then pay that line of credit with the profits that they make, and rinse and repeat essentially forever. But the bond buying program is a little bit more of a mystery to a lot of folks, because when they say that they want to get some more money out into the economy, what the Federal Reserve does is they buy bonds. And what that does is they are purchasing bonds and they are putting money out into the economy, okay? And so our monetary supply ends up going up. And if you guys have taken any look at the M1 money chart, the amount of money that has been pumped into the economy in the last year or so is a 4x increase in the amount of the total circulating supply, which is really one of the major things driving this insane rate of inflation that we have, that in 2021 is going to be about 7%, which is just simply not sustainable. So then when the Federal Reserve wants to taper down and start selling off their bond positions, that is, they are going to sell them, so people are going to buy them, and that is going to take money out of circulation, out of the economy, and then they can essentially burn that money and have it removed from the monetary supply in order to get inflation under control. So those two things are the things that the Federal Reserve is going to start doing in order to get a hold of this inflation and to have ammunition in their magazine for when the next crisis comes along, because they cannot just continue to accumulate these bonds and these treasuries and these securities indefinitely. As far as I know, I mean, I guess they theoretically could, but it would end up being such an inflationary stimulus that there would be such negative downside to it that it would hurt individual people like you and I. Because if you think about it right now, what are the chances that you are going to get a 6, 7, 8, 10% increase in your wage next year? And that is how inflation ends up eating away at your purchasing power, because the price of objects and the price of things, the price of services and fuel and everything that people use on a daily basis will start to outpace the amount that they are able to afford them. And so that is going to be a very fine line for the Federal Reserve to walk, trying to balance fighting inflation, putting the tools back in their toolbox for financial emergencies in the future, and not crashing the stock market, the crypto markets, the housing markets. It will be a tough thing for them to do. Now, they haven't done a tremendously good job of anticipating this inflation. They did say that it was going to be transitory up until, just a couple of months ago, when they've said, hey, I think inflation's here to stay and we need to do something to fight it. So we will see where this goes, because I know that you and I out here in real life, not sitting looking at data, knows that things have been inflating at a tremendous pace, from food to fuel to vehicles to basically anything you buy. So we will see where the Federal Reserve goes with this. We'll see if they definitely taper back and start selling their bond positions. We'll see if they stick to this 0.75% interest rate in 2022, and then 5 more rate hikes over the next 5 years. It will be something to look at. And this is something that you guys need to be aware when you're investing in stocks, when you're investing in crypto, when you're investing in pretty much anything for the next 3 years going forward, as far as what their value will be, how much downward pressure will be put on this, and how much you think the economy can grow in order to offset this downward pressure. So guys, if you like this video, you got something out of it, be sure to hit that thumbs up button for me. I really would appreciate it. It helps me out in the YouTube algorithm. If you haven't subscribed here yet, hit the subscribe button down below, hit the notification bell so you don't miss anything that I put out on personal finance. I appreciate you guys watching today, and I'll see you on the next one.